So on Thursday morning, I woke up and was greeted by a sea of red. Seems like Christmas has come early. Ho ho ho. Though, not everyone was amused. Some people blame the man who seemingly caused this crash, while others asked for his removal. I hate to be the bearer of bad news, but unfortunately, Trump has mentioned that he won't be firing Powell, and Powell isn't going to resign anytime soon. All jokes aside, the S&P 500 has fallen by almost 3%, to which Bloomberg calls the worst Fed day since 2001, while others calls it a market bloodbath, and wondering whether it is a start of a bear market. One even said that because of this drop, Powell has made a lot of people poor. I don't know what they are talking about, because according to my S&P 500 chart, the S&P 500 has gone up by over 23% year to date, and over the past 5 out of the 6 years, the market has given insanely high returns, far above the average 10% that it was supposed to give. So much so that everyone is starting to think that they are an investing genius in a bull market, where everything that they are investing in is going up. Tesla went up over 200% from its low this year. Palantir is up 300% year to date. MicroStrategy is up 600% before coming back down. Heck, even the age is starting to sound like an influencer, telling you that Bitcoin is essential to your portfolio. But after this mini 3% crash, I guess the question you may now be wondering is, where is the market going to go next, and how long this bull market is going to last? Before I answer that, let's look at why the S&P 500 fell in the first place. And it all has to do with this man. I mean, the meeting he was in. So what happened was that back in September, the Fed projected that in 2025, they were going to cut rates all the way to between the 3 and 3.5% range. But in the latest dot plot, it shows that they are going to keep it around the 3.75 to 4% range. This means they have become a lot more cautious and will be keeping rates higher than what was originally expected. This is because they are now expecting the inflation rates to stay higher for a little while longer. For example, for 2025, they were originally expecting inflation to go down to the 2.1 to 2.2% range. But now, they think that it could be around the 2.5 to 2.6% range, with one even thinking that it could be at the 3.1% range. Likewise, they've slightly increased their inflation expectation for 2026. But ultimately, most of them still think that inflation should return back to the 2% baseline by 2027. Quick pause. If you are looking for the cheapest way to invest, check out Interactive Brokers. It has the lowest fees for stocks, ETFs, options, and so on. Their currency exchange rates are practically the same as the one you see on Google, and they offer tons of free analysis tools to help you with your investing journey. This is the best broker, and it's the one that I'm personally using. Sign up link down below to Interactive Brokers if you're interested. Alright, let's get back to the video. So, what does this mean for the stock market in 2025? Prior to this mini dip, many analysts were warning that the S&P 500 might be weakening soon. For example, just a few days ago, Bloomberg reported that the S&P 500 rally is now showing cracks as most of the stocks were left out. What they found was that the equal-weighted S&P 500 has been falling for 7 consecutive days since last Tuesday, which ties for the longest losing streak since 2018. The reason we don't see that in the S&P 500 was that many of the top 10 stocks were going up during this period and are helping to offset this loss. But what is causing many of the tech companies to keep going up over this period? The short answer is nothing other than greed and euphoria. For example, if you compare the S&P 500 change in forward 12-month earnings per share versus change in price, you can see that the change in price started going up since early this year, while the change in forward 12-month earnings per share didn't go up as much. The last time this happened was back in 2020, where meme stocks and cryptos were pumping up like nobody business. And we all know what happened next. The market peaked at the end of 2021 and it went down 25% after that. Here's another one. The S&P 500 is now trading at the upper range of its valuation of around 22 to 23. The last time it did that, it was in the 2000s, right before the dot-com bubble crash. Here's one more. An analyst showed that since 1885, the last 4 times the S&P 500 was this overvalued, it saw a steep drop. And now, is starting to look like it's happening again. They warn that if the S&P 500 follows the path of a classic mania, it could rally all the way to around 6,004, which was about 6% before that mini 3% drop, before falling back to 4,750 next year. Similarly, Goldman Sachs predicted that with the S&P 500 being so overvalued, we might only see anywhere between -1% to 7% over the next 10 years. So, with so many warning signs flashing red, does this mean that it's time to sell away all your stocks, wait for it to drop, and buy back when it's cheaper? I'm just an influencer, not your financial advisor, yeah. So I can't give you any financial advice. But maybe the age is better than me at that. However, it's always worth remembering that the stock markets can stay irrational longer than you can stay solvent. That's because market all-time highs tend to lead to more all-time highs. In fact, JP Morgan found that there's not much difference whether you only invest at all-time highs versus any other period. But I thought the stock market is super overvalued now. Won't the market boom and crash 100% from here? As it turns out, market corrections are very common, even when we are in a bull market. For example, we will typically see a 5% correction 3 times a year, a 10% correction once a year, and a 15% correction once every 2 years. So probably this is one of those times. And unlike what many might think, a crash doesn't happen just because the market is overvalued. If it was this predictable, every other genius analyst, including Michael Burry, would be shorting the market right now. Instead, crashes happen when it's least expected to happen, like another pandemic, or another war, or another bubble that we didn't notice just pop. Right now, we don't see anything like that happening just yet. And even though the market is overvalued, the US economy is doing well. Inflation is low, and the job market remains strong. In fact, based on history, whenever the S&P 500 saw consecutive 220% back-to-back returns, there's a 75% chance that the third year is positive too, with it giving an average of 12.3% return. The only times it was negative was during the 1970s, where there was high inflation, and 2000, where there was a dot-com bubble. Similarly, almost every analyst is bullish going into 2025. Well, except for that one guy. And I've no idea how Bank of America got 6666 as their number. They are probably trolling here. Tom Lee, the former bull, also thinks that the S&P 500 could reach 7,000 points by the middle of next year, due to reasons such as enthusiasm about Trump coming into power, deregulation, and tons of cash still sitting on the sidelines. However, after that, he sees the S&P 500 pulling back to 6,600 by the end of the year. This was because based on the past 5 20% rallies in consecutive years, the second half of the third year has been negative. This could be due to macroeconomic reasons, such as wars in the Middle East, Trump tariffs coming into effect, and cost-cutting by Trump's Doge department, which could effectively slow the economy. Okay, here are my thoughts. Obviously, no one can predict what's going to happen in the future. But what's certain is that in the short term, anything is possible. For example, from 1950 till now, whenever the market is at all-time highs, if we only look at the 1-year horizon, there's been a 10% correction 9% of the time. But if we look at 3 years out, this occurrence drops to just 2%. And over a 5-year period, the market has recovered from any correction. So if you try to sell now and aim to buy back later, who knows, maybe you have managed to avoid a huge crash and you end up becoming an investing genius like Warren Buffett. But statistically speaking, there's a higher chance that the market could continue going up another 10 to 20 or even 30% and you miss the entire rally. Not saying it will, but just saying it could. If the market does rally higher, you can end up missing the best days in the market and getting much lower returns than everyone else, or even start getting negative returns. Many people think that in order to do well in investing, you need to pick the right stocks, choose the right sectors, read economic data, and analyze everything this man said. But I think this guy on Reddit summarized it nicely. Investing is a soft problem. To do well in investing, all you need to do is just stay invested over the long term, invest in a globally diversified fund, and just get repeatable returns for an above average amount of time by staying in the market so that your wealth can compound. That's all. That's the only thing you need to do well in investing. But most of us won't be able to do this. Why? Because we find this boring. Every day, we will always see someone chasing after some stocks with high returns, bragging how much they made yesterday, doing this, doing that. Like, if you guys put the same amounts of effort into increasing your salaries and earning potential instead of day trading stocks and ETFs like Pokemon cards, you will be better off than 99% of the people around here. Anyway, that's all for this video. Hopefully you found it useful. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.